Okay, this clip was sent to a WhatsApp chat group that I'm a member of, and I thought it's worth commenting on. It's a politician. It's a gentleman called Godfrey Bloom, who was at the time a member of the European Parliament for the United Kingdom Independence Party. This speech was recorded in 2013. Okay, let's just have a watch of this 1-minute clip. Like is common with so many politicians these days, his tone is very strident. He is 100% sure, 100%, not even an iota, not even 0.001% of doubt that something he is saying may actually not be correct. So he's very strident in his tone and in his approach. But let's have a look at what he actually says and dissect the validity of what he's saying.
Commissioner, Mr. President, I rise again, I'm afraid, to make the same old hoary speech that I've been making here for several years, and that is, it is my opinion that you do not really understand the concept of banking.
So always good to start by telling your audience they don't understand something. Let's just see if this fellow then goes on to demonstrate that he does understand it.
All the banks are broke. Bank Santander, Deutsche Bank, Royal Bank of Scotland, they're all broke.
Okay, all the banks are broke. I mean, there's about 12,000 of them in Europe, I think, maybe a bit less. Maybe there's 30,000 of them around the world. Let's stick to Europe, I suppose, because he's speaking in the European Parliament. All the banks are broke. I don't need to pull out any stats to simply say that's a nonsensical statement. We could probably pick out many thousands of banks in Europe whose share capital, when we work out their market valuation, is a plus number. In other words, their liabilities don't exceed their assets. So it would be very easy to demonstrate in about 20 seconds that not all the banks are broke. He does list an institution that at the time, and still up to now, is UK public sector owned or majority owned, Royal Bank of Scotland, because it was bailed out by the taxpayer in 2008. He's correct on that one. That bank was broke in October 2008. Literally, they needed government capital injection, otherwise they would have had to be declared bankrupt. So he's included that one. He's mentioned Santander and Deutsche Bank. As far as I'm aware, they've never had a government bailout. So it's pretty easy to demonstrate that he wasn't right with that one. But to simply start out by saying all the banks are broke, I'm wondering what exactly he's trying to say there, because it's clearly a nonsensical statement.
And why are they broke? It isn't an act of God. It isn't some sort of tsunami. They're broke because we have a system called fractional reserve banking, which means that banks can lend money that they don't actually have.
Right, fractional reserve banking. This is beloved of academics and also within monetary policy theory. Fractional reserve, I'm going to put this down to literally 30 seconds worth. You could have a 5-day-on conference on this. Fractional reserve banking, in essence, states that every time a bank originates a loan, every time it lends money to someone, it simultaneously creates the deposit. In other words, it's creating money. Now, at the macro level, one could see that that's an accurate statement, because if I'm a Martian looking at Earth, every loan is matched by a deposit because it's funded by somebody. If I borrow money from you, my loan is matched by the money you have given me. So every loan has a deposit of funding on the other side. But is it relevant to individual banks? Absolutely not. It's not relevant at the individual banking level, because loans have to be funded. So, and they can be funded either by deposits or by the bank's own money, its shareholder capital. Sometimes these days banks also use central bank funding for business as usual lending, or it can use institutional investors' money. It can issue a bond in the market and lend that money. But the loan has to be funded. Banks don't just magic up money out of thin air. As I commonly say to academics once we've agreed to disagree at the end of a debate, why don't we try it? Let's go sit on a park bench somewhere in Hyde Park in London, or any park in London, put up a sign and say personal loans available, £100 to £10,000, 1 to 5 years maturity, come and get them. Let's wait for the first customer to come along and say, I'd like to borrow £1,000 off you. Let's see if we can simply write that on a piece of paper and say, here's your money, and see how far we get. Let's try it. Let's try and lend money to someone by creating the money that we lend him or her. It's not going to happen. At the individual bank level, fractional reserve concept is actually irrelevant. A bank has to be able to fund all its loans at the time it makes the loans. And an inability to fund them at any time causes banks to fall over, which is exactly what happened to Northern Rock in 2007, a UK bank in 2007. The fractional reserve point is introduced, I would surmise, by this gentleman because his real problem, I think, isn't with the banking system or indeed fractional reserve. I think it's with the central banks introducing QE and keeping quantitative easing. Let's carry on and have a look at what he says.
It's a criminal scandal and it's been going on for too long.
A criminal scandal. Okay, well, until there's a law against something, I'm not sure that something can be criminal. Perhaps we should introduce a law against fractional reserve banking. See where that got us.
To add to that problem, you have moral hazard, a very significant moral hazard from the political sphere.
So he's moved on to the subject of moral hazard. There's a strong argument, which I 100% agree with, that every time someone is bailed out for their own mistakes, other participants, other players in the market will think, well, it's okay, I can take as much risk as I want, and if things are good, I'll make money, and if things are bad, the bank will get bailed out. So moral hazard is a strong argument against saving any failed financial institution. But I don't think it's a strong enough argument to prevent saving a financial institution if by doing so, the economy itself was driven into severe recession. So it's a fine line argument. Is a firm worth saving to save jobs or a knock-on effect on the economy, or should we let it go to the wall to avoid moral hazard? That's a valid debate to have at any time.
And most of the problem starts in politics and central banks, which are part of the same political system. We have counterfeiting, sometimes called quantitative easing, but counterfeiting.
So this is his real bugbear, I think. He doesn't like quantitative easing. Quantitative easing. Money printing, absolutely. Money printing by any other name. But quantitative easing, when banks in developed economies, Western economies, after the 2008 crash, started essentially printing money, issuing bonds which they financed themselves, to enable governments to provide public sector support to either failed industries or as part of their own budget to financing process. It's not quite counterfeiting, because the bank is creating more of the legal currency, the legal tender in that country, the central bank is. Now, if his problem is with quantitative easing, and that's what I think it is, that's a separate argument to banks being broke or fractional reserve banking being a criminal activity. But this, and I think this is what makes his argument so lightweight, because there is an argument one can make against quantitative easing, particularly if it becomes a business as usual measure. It goes beyond an emergency measure and stays in place for a very long time. What in effect has happened then is that the public sector starts to underwrite the private sector of the economy, and it becomes a normal thing, a business as usual. So there's an argument that quantitative easing carried on for too long and got too large. But if that's the argument this fellow had, I'm wondering why he had to say all the other nonsense first before he got to it.
By any other name, the artificial printing of money, which if any ordinary person did, they'd go to prison for a very long time. And yet governments and central banks do it all the time. Central banks repress the amount of interest that rates are, so we don't have the real cost of money. And yet we blame the real retail banks for manipulating LIBOR.
He's now become the bank's friend. So he said central banks kept rates artificially low. Well, certainly in 2013, he probably didn't know how right he was going to be on that point, because central banks did really kind of miss the post-lockdown rise in inflation and kept rates low for far too long. In the European Central Bank kept rates at negative for about 7 to 8 years. So he, on that point there about rates being depressed at low levels for too long, speaking in 2013, 10 years later, he would have been proved right that they were kept for a very long time. But this is separate to the banking system. They are only indirectly connected. If your argument is about monetary policy, keeping rates artificially depressed for too long, that's a monetary policy argument. He then decides the retail banks are his friend because he's saying you're blaming them for manipulating LIBOR. So when it was really the fault, when really it was the central banks who were keeping rates low. So it's a very incoherent argument that he's making.
The sheer effrontery of this is quite astonishing. It's central banks that manipulate interest rates, Commissioner. And plus, underneath all this, we talk loosely, in a rather cavalier fashion, do we not, about deposit guarantees. So when banks go broke through their own incompetence and chicanery...
I was amused when I heard those two words. I mean, you must admit that banking is not a complex business to be involved in. It's not like undertaking brain surgery on a human being, or indeed trying to land a fast jet on a moving aircraft carrier's flight deck. Banking is a reasonably simple activity. So to be in charge as a collective, as an executive body, of a bank that becomes unviable, I think the charge of incompetence is unarguable. You can't get away from it. Banking is not an activity, a business, a line of work that is so complex that it's beyond the wit of a reasonably competent person to undertake successfully for a long period of time. So when he refers to incompetence, I'm afraid I'm going to have to agree with him, much as it pains me to say that. The chicanery point I shall leave aside. That's debatable, I suppose. But one can't deny that incompetence got a lot of banks into trouble, the ones that failed either in 2008 and, I dare say, as shall be proved over the course of time, in 2023 as well.
The taxpayer picks up the tab. It's theft from the taxpayer.
Yes, the taxpayer does pick up the tab if the government decides to bail out any corporate entity. It could be a steel-making company, or it could be a petroleum company, or it could be a car manufacturer. The taxpayer picks up the tab. That's what taxpayers do if their elected government decides an industry or part of an industry or an institution is worth saving. That's the way it goes. If you decide it's worth saving, the elected government decides it's worth saving. He mentions the deposit guarantee scheme. That's actually funded by the banks themselves in the UK. I can't speak for other economies. Some countries have deposit guarantee schemes and some countries don't. Developed economies often do. In the UK, it's funded by the banks themselves. But of course, that if a bank does fail and the mutual pot of the guarantee scheme isn't sufficient to cover the depositors, then of course the taxpayer would take up the slack. But again, if an elected government decides that a bank is worth bailing out to avoid worse harm to the economy and to enable depositors not to lose their deposits, then the taxpayer takes the bill out. I'm not sure what this chap's solution is here. See, it's very difficult to take the whole speech seriously because there's so many things thrown in an incoherent, jumbled way without any solution being presented.
And until we start sending bankers, and I include central bankers and politicians, to prison for this outrage, it will continue.
So there you go, there's his solution. We need to send politicians and bankers and central bankers to jail, otherwise this will continue. That's his solution for the financial market system in the developed world, or indeed the whole world. There you go. Godfrey Bloom, thank you for presenting us with that amusing speech from 2013, which I wasn't aware of until someone sent it to me on WhatsApp a couple of weeks ago. Okay, thanks for watching. See you soon. Bye-bye.